Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. Really excited for today's show, and I probably haven't been more excited for a show in a long time. But we've got Mark Kenney on the line with us today. So, Mark, welcome to the show.
Thanks for having me, Brian. It's good to see
Yeah.
you.
Good to see you too. Now, you probably don't remember this, but 5 or 6 years ago, when I was like a brand new syndicator, I had closed like two deals. Someone put us on a panel together,
I
right?
do remember.
You do remember that, okay? Now, I remember thinking I was hot stuff, and I get on the panel, and I gotta say, just standing next to you was a little bit intimidating for me at the time. You had many, many units, and I walked away with a whole lot of respect for you. I mean, the amount of value you gave in a very short time on that panel was absolutely incredible. I learned a lot. I thought I was going to go out on that panel and teach and preach, and I think I learned more from you than anything else that month, probably. So, anyway, thanks for that. Anyway, that said, let's talk about you here. So, do us a favor and tell us what life looked like for you before multifamily.
Yeah, I started buying real estate
Yeah.
over 30 years ago in college with a
Okay.
twin brother and got married pretty young as well. Started buying two to
Okay.
four units typically. But as far as corporate world, I was a CPA, financial accountant for a
Okay.
while. Then I transitioned into management consulting for the Big Four and
Hmm.
kind of always kind of skirted around business and IT. And then I worked for a software company
Hmm.
named SAP, which is a pretty large
Yep.
German-based company. Started my own IT company 2008. That's pretty much what it looked like for me and it was more of a 80 to 100 hours a week, pretty
Hmm.
much every week working.
Okay.
Any project that came up, I wouldn't turn it down.
Okay, good, good. But it's your own company, so you're working for yourself at this time, and a little bit different than working for somebody else 80 to 100 hours a week.
Oh, I did that for myself too.
Yeah. Okay, got it. Got it. Got it. So, why did you transition into multifamily to begin with? It sounds like you had a bunch of smaller properties first, but why the larger multifamily? Why the syndication?
Yeah, so I had a friend that was syndicating a deal, and I'm
Mhm.
like, it makes sense. So I invested in his deal and then a couple other deals. And even though IT wise was going, relatively well from a overall financial perspective, things like that, just the balance, life work balance was not working for my wife.
Yep.
And she's like, you need to do something different. And I'm like, yeah, my spare time, let me go figure out something else. So, long story short, we both liked real estate and we ended up going to an event and separately, actually, just because of schedules. And we're like, we can do this too.
Hmm.
So, my goal was to stop doing IT.
Okay.
And I was to the point where I'm like, I don't necessarily have to replace all my income to stop. I just need enough to, cushion as well to live and things like that. And we were able to do it relatively quickly
Hmm.
within, I think, less than 2 years or so. I was able
Okay.
to stop working my IT job.
Nice, nice. So you were working, presumably you were working full-time IT for the full 2 years and syndicating at the same time.
Correct.
Okay, got it, got it. I did something similar, and for me, people ask me what it looked like, and I always say it was like working two full-time jobs at the same time, right?
It is.
So, yeah, absolutely. But
You figure out how little you actually have to sleep and live.
and yeah, and you figure out how many things you don't have to do that you normally do
Yeah.
too.
I,
Like,
I figured out it's about 3 hours a night.
yeah, yeah. I mean, I stopped watching Netflix. I stopped doing like anything, that a lot of my hobbies went to the wayside.
Right.
I was either working, I put fences around, certain family time things, and then everything else was multifamily.
Right.
Wake up Saturday morning, 4 to 5 hours of multifamily before the kids get up. So
Right.
yeah. So sounds like that hasn't changed in a while. But about what year was this when you went full-time multifamily?
2016.
2016. Okay, got it. Got it. That helps. You've also built a coaching program, Think Multifamily. How did that start and why did that start?
I had no ambitions to do coaching or anything like that. If someone would have said, "Hey, you're going to do this," I would say, "No, I'm not." But reality was, we were part of another group, and we
Mhm.
just felt like there was certain things that maybe could be done differently. And we had a number of people asking us to do stuff, and we started
Yeah.
doing meetups initially, and then some webinars once in a while, and then kind of just realized that there were, in our opinion, a lot of things that really weren't discussed
Hmm.
On the multifamily side, kind of maybe more
Yeah.
the harder part or the more detailed pieces.
Hmm.
Everyone's just like it's easy, anybody can do it. It's not true. You can't just do anything you want to do. I can't go dunk a basketball, no matter
Yeah.
how much I practice. I'll never do it my entire life.
Give you a little trampoline, and I'm sure you can
Yeah,
do it.
throw it. Oh, maybe if it's short enough hoop, but
Six
um,
foot hoop, I can dunk all day.
that's right. So
Yeah.
it was kind of more. I just felt like more things could be shared,
Mhm.
and then just the culture. We wanted more. Our group was called Family Syndication Group. We wanted to build more of
Yeah.
a family atmosphere. It
Hmm.
was just something with the community, and we built like a lot of really, really good friendships from
Yeah.
doing that. And during my IT days, I really didn't have that, and frankly, didn't really care about it. I didn't.
Hmm.
My wife was really the one more driving around the community, and I downplayed that a lot initially because
Hmm.
I'm just like, it's all business. Who cares? Just go out and do
Yeah.
deals. But that was what really was very attractive to a lot of people was the community
Hmm.
aspect of it and how people
Yeah.
built lifelong relationships.
Yeah. So you started out building a community, and eventually it seems like you scaled and you had a pretty sizable community and kind of, I'd call it more of an ecosystem based on talking with the people that were in the program. What did that look like at like the peak of, your business?
Yeah, we were doing live events a couple times a year.
Mhm.
Some were more just general
Yeah.
multifamily. And then we did I think it ended up turning into a 3.5 day deal analysis workshop where you bring your computers and literally all you're doing is working through deals. It's like if you
Yeah.
don't like numbers, you're going to go crazy, but it's very, very detailed, technical. And I kind of lean more towards that way. And sometimes I have to kind of scale back a little bit to be like,
Mhm.
okay, people are at different levels, right? Not everyone likes numbers and things like that. And then it was really one-on-one coaching.
Mhm.
So I did all the one-on-one coaching. We didn't
Yeah.
didn't have like sub-coach model or anything like that. Structured a little differently, and we had group that in that one-on-one coaching we would do group stuff as well. Like we'd have
Yeah.
training just for
Mhm.
the group, and then we'd have calls like twice a month as well with
Okay.
that group.
Okay. Awesome. Awesome. Interesting. Now, you're one of a couple of different coaches that would partner with the students. So I've heard that from a lot of the students that have been on this podcast talking about deals they've done. But I want to get your perspective. What led you to start doing that? And how often and how many times did you do that?
What really kind of led to it was most people starting out, even if they were experienced in the business world and things like that, you need certain things, right, to be able
Yeah.
to do a loan. And three main things you need net worth,
Hmm.
typically 100% or more of the loan amount, and
Yeah.
liquidity after closing needs to be 10% or higher of the loan amount, which a lot of people just didn't have.
Yeah.
And then the third piece, which is even getting more stringent now, you need to have experience. So
Right.
it's kind of like when you go graduate from college and everything you look at says you need 2 or more years experience. You're like, well, how do I get that if I can never get a
Yeah.
job? Right. So
Yeah.
kind of the same thing and loans, right? We had some, and have some really good relationships with brokers, and we're like, hey, we'll make introductions to brokers. You can kind of like hunt deals. I did it a lot of
Hmm.
deals.
Yeah.
Looking back at it, I should not have done as many deals.
Yeah.
I downplayed just by being, not as experienced. The whole concept of non-recourse loans with no personal liability is a complete, I'll just call it a complete lie. It's a complete
Yeah.
lie for some lenders because you still have what's called carve outs and things like that. And some lenders will just make up stuff too. It's just reality. And some people are like, I don't think all lenders are like that. Well, I'm not saying all of them like that, but there
Yeah.
are enough of them out there that put a bad taste in your mouth. You have the concept of, let's say you and I are partners, and I would say, well, hey, Brian, you're newer too, but you can sign on the loan too to get experience. And then, I'm going to throw you under the bus for a second. You go off and
That's
go steal a
fine.
bunch of
Yeah.
money and do all these fraudulent things. I know nothing about it. I'm not involved in it
Yeah.
or anything like that. Well, there's something called joint and several terms you should know if you're going to
Yeah.
sign a loan document or some other agreements as well. So whatever Brian does, I'm 100% liable, whether I know
Yeah.
about it, participate or not. And whatever I do, Brian's 100% liable, whether he knows about it, participates or not. So
Yeah.
I didn't know enough back then. I'm like, now I'm recourse. What's the worst thing that could happen? Well, the worst thing
Yeah.
that could happen is a lender could, try to sue you
Yeah.
and try to sue you for full recourse, the full loan amount. And that's reality. That's what can
Yeah.
happen.
Yeah, yeah. And I mean, in your defense, I mean, nobody was losing properties. That wasn't happening at the time, right? So it had been probably 10 or 12 years. Well, since like 2008, 2009
You're right.
timeframe, that
That's
happened,
right.
And so nobody understood those risks. We were so far removed from the last time that lenders did that, that a lot of people glossed over that, right? So,
Yeah. Going
um,
forward, just
yeah.
kind of as a comment is that you can negotiate all those things more than we never thought. Just say, hey,
Yeah.
it is what it is. I just did a refi in January and I redlined the heck out of the loan
Hmm.
docs. I
Yeah.
had an attorney involved too, but I'm the one to redline the heck out of them. I'm like, nope,
Yeah.
nope, 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 not doing
Yeah.
that. Nope. And you want to be able to limit your liability, right?
Yeah.
As far
Yeah.
as to some sort of infraction. You're never going to get avoid like if you go out and want to commit fraud and steal money, you should get in trouble. Like nobody
Yes.
should argue that. So you're not going to get that out of there. And then the other piece is you don't want anything to be like unquantified. Like what is the
Mhm.
risk? Well,
Yeah.
to be determined. That's not a
Yeah.
good thing.
Yeah, absolutely, absolutely. And just more for people listening than you, Mark, but a lot of people are going through struggles with lenders. It is real. It is absolutely real here. So let's talk about like the partnership structure that you had with your students. How would you line those up? What were your responsibilities, their responsibilities, and so forth?
It would vary a little bit depending on who the person was. So in
Yeah.
some cases, someone might be more of like a deal finder, right?
Yep.
But they don't want to necessarily operate and run the property as an asset manager. So it would kind of depend, but the different pieces of it would a lot of people are like good at underwriting. They have an
Yeah.
IT background or whatever it might be, good in math. And other people are like, I'm really good at dealing with people. So I want to go talk to brokers and try to bring capital. The deals that I would, participate in,
Hmm.
at a minimum, I was signing the loans and I was making introduction to brokers and things like that, helping them underwrite the deals. Some cases we would provide the asset management piece of it. And then it just would depend on the other components of what, raise capital from investors was always like, a hot ticket for a lot of people that were new, like, hey, we can't raise money, never
Yeah.
done it before. And we're always like, well, at least try. Worst thing
Yeah.
is you get to zero, but at least you'll learn something from doing that. And
Yeah.
then we would raise, capital. We did quite a bit. I mean, we did like,
Mhm.
maybe about a 1.5 billion in transactions
Yeah.
in a pretty short
That,
period of time.
that's quite a bit. Yes, I would
Well,
agree.
it's probably 500 million more than I wish I would have done, but
Yeah. Yeah, hindsight's 2020 though.
yeah,
I mean, the reality is, if things would have turned out a little bit differently in the last couple of years, you'd be sitting on top of a mountain of gold,
that's
and
right.
I mean, but yeah, so bottom line, different coaching, different structures with different people, and that makes sense. That makes sense. And you did raise capital. Were you providing earnest money for some of these deals
I did.
or also
I wasn't the
negotiable?
only one. I did on a number of
Yeah.
deals. I mean,
Yeah.
at that point in time during the, kind of heydays, I mean, we'd have
Yeah.
times where we have, $1 million of
Mhm.
money out on earnest money hard
Yeah.
on deals. I would, and at some point in time, you kind of you get tapped out. I mean, we did 120 deals. People are like,
Mhm.
oh, why don't you put? I'm like, okay, I have 120 deals. Like, what do you,
Yeah.
what do you want me to do? Like,
Yeah.
there's only so much money to go around, and it's like, and you're waiting for some deals to sell, and some of the
Yeah.
deals, a lot of them, didn't make any money. So, but I would. It was in the good thing about the community was I might have had net worth, for example, on a deal, but I'm like, I'm not liquid right now. I put
Yeah.
money out. So somebody else would come on and sign as a KP as well,
Yeah.
provide liquidity, earnest money. It was very common where there could be, up to maybe five people putting earnest money in. And then
Yeah.
they get some part of the deal for doing that because they're
Mhm.
putting money at
Yeah.
risk. And we would distinguish between whether it was hard, meaning it's, at
Yeah.
risk really, or not. And then the percentages would change based on that. But we split up each piece of the deal, whether it's finding the
Yeah.
deal, earnest money, signing the loan, asset managing, all those components. And people just generally will navigate to certain, usually one, maybe two areas. Very few people will be like, I'm doing it all. I mean, I've worked on all the areas like multiple times, but it's not like I like all the areas equivalently, or
Yeah.
that I'm even as good in all the
Yeah.
areas. And
Yeah.
somebody else could be way better than me in a certain area. I did out of necessity. First time I started syndicating, it was just one other guy, me.
Yeah.
And that was it.
Yeah. Yeah. And by the way, when I would do podcast episodes, it was part of the reason I started the podcast is to find potential partners, right? And one thing I hated about your program, and this is going to be a compliment when I finish, right, was that everybody in your program, when we closed down the show and I started asking questions, hey, are you open to partnerships with us? Are you open to this? Are you open to that? Almost every single one of them has said, no, I'm good. I'm good. We got a great community with Think Multifamily. A lot of things are going well. We're going to stay over there, right? So, I mean, you're definitely doing something right as far as that community ecosystem goes.
Just to
Yeah.
clarify, we didn't drive that. We really didn't. I
No.
was always like, hey, whatever you want to do. The only thing I
Yeah.
would say, and it happened on a couple of deals where I said, if you want me to partner in the deal, I need to know who the other partner is going to be. And it happened on
Yeah.
one deal where I knew the other guy, and
Yeah.
this person didn't, and I'm like, I'm not partnering on the deal. Like, I
Yeah.
know some stuff. I'm not going to go into details. I'm not
Yeah.
partnering with that guy. So, but if they wanted to go partner, which happened a number
Yeah.
of times, people would go partner outside the group, and I'd still coach them, totally
Yeah.
fine. I just said, I'm not going to coach your other guy that's not in the
Yeah.
group. We had a pretty tight community.
For somebody who built a podcast to look for partners, everything multifamily, the community was just, it sounded from outside looking in like it was just completely awesome for the time. All right. So you have the community going, you've got students looking for deals, you're partnering. Are you doing deals of your own at this time, or are you
I
completely
am.
doing, you are, okay.
Yeah.
Yeah.
It transparently caused some
Yeah.
issues too, because
Yeah.
some of the people are like, well, you're doing your own deals and you're raising capital. I'm like, yeah,
Yeah.
I am. Yeah. And
Yeah.
I get it from some, because they're like, man, we're trying to do a deal too. And you're helping us on your deal, and you raise money on your own deal. I'm like, yeah, but I'm not going to stop doing deals. And
Yeah. Yeah, I have a handful of coaching clients and nowhere near where you're at, but my partner and I talk about this a lot, where to focus. And my opinion is if you're going to be a good coach, you have to be doing the deals. You
you
have
do,
to be doing both
you do.
sides. So when you said that, my immediate response was, of course you're doing your own deals, right?
That was my response. That people were
Yeah.
like literally getting there. It
Yeah.
caused some tension,
Mhm.
you know.
Yeah. Yeah.
I mean, it's
I
very
can.
stressful to go try to raise money in your first deal, and you're trying to raise. We were doing big deals at the time. Some people
Mhm.
were doing too big of deals
Mhm.
for their first deal. But I mean, we would
Yeah.
have certain points in time. We would have 5 to 7 deals all going on at once.
And I mean, 120 over a certain period of time, that's a lot. If I do 120 in the next 15 years, I think I'm going to be happy. So,
Well,
uh,
going slow is not an issue as long as you're going.
yeah, yeah, exactly. Exactly. 2022 rates started going up. Let's, look right before that. Where were you sitting? How many deals? Ballpark numbers, what percentage were like variable rate loans versus fixed rate loans and things like that.
Before 2022, we had done 95, maybe
Mm.
maybe a little higher than that, because we stopped buying, in 2022. We did one deal in
Yeah.
2023 as a fixed deal, but
Okay.
so 2022 we ended up buying like 2022 deals on, just happened to
Yeah.
match to the year.
Mm.
So about 100 deals prior to that. We
Yeah.
had done 85% bridge debt.
Yeah.
Other ones we were buying, some were, Fannie Freddie right out of the gate. Most of the deals that we bought in the early days, we were able to either sell or refinance
Mhm.
into Fannie or Freddie, really with no issue at all. I mean,
Yeah.
even after 2 years or less,
Hmm.
the deals. And so, but we had bought a lot of, value add gets thrown out there, which I understand. But I would
Yeah.
call we bought a lot of distressed deals. We bought properties that were 0% occupied,
Hmm.
30%, 50, and properties that were 95% occupied,
Okay.
and kind of everything in between. In those days, even with the bridge debt, you didn't really have the interest rate fluctuation that happened started in 2022.
Yeah. Like the federal funds rate was zero,
Yeah,
essentially.
and then
Yeah.
it went up 11
Yeah.
times in a row.
I'm going to say from like 2019 to 2022, most of your Fannie and Freddie's were mid threes for that
Oh
entire
yeah,
time.
yeah, yeah. And no, they
Yeah.
were. Yeah, and
Yeah.
we have. I
So,
think the lowest we have is like maybe 3.32. And just as a side comment, because I think it is relevant, is that people are like, well, why didn't everyone just do fixed agency debt? Well, a lot of properties didn't qualify for
yeah,
one.
exactly.
And even if they did, and you're like syndicating and saying, I'm going to sell this after like 3, 4 years. And if you would have gotten into like, let's say a Fannie that has yield maintenance, you don't need to know necessarily, we'll look it up, but it's basically a bad prepayment penalty. So
Hmm.
to put that in perspective, if we had the same deal on a bridge loan, we would pay usually between 0 and 1%
Hmm.
prepayment penalty.
Yeah.
Well, on a Fannie loan, we sold this deal, I think it would have been in 2021,
Hmm.
2020, I don't remember. But anyways, like $8.25 million loan, but
Hmm.
our prepayment penalty was $2.4 million on that with Fannie.
Yeah.
Reality, I'm not, not diminishing the idea of having fixed, but you also have to consider the whole aspect of defeasance, yield maintenance, and then other prepays. They're known. Like on a Freddie, you might do step down. So at
Yeah.
least you know what that is versus getting into something like, well, I don't know what it's going to be 3 years from now. You're not
Yeah.
mitigating your risk.
Yeah. The very first loan that I got, first two loans that I got were Fannie Mae. And I've said this hundreds of times. I didn't understand yield maintenance because, 2 years later, we were trying to set, we bought it in 2019, and 2 years later, it probably doubled in value, but a $3 million loan with more than $1 million prepayment,
Yeah.
you know?
So
Yeah.
that's the thing where people, I mean, it's easy, like you said, to go look back and people are like, why is everyone so stupid? Why were they such idiots? Why did they do this? Why did they do that?
Mhm.
Well, the people that were making, 300% in 3 years,
Yeah. That's how they were doing it.
that's reality, right? So,
That is how they were doing it,
right.
yeah, the higher you leverage, the better your returns. And talking about the rates going up and the bridge loans, and you had some exposure to obviously the rates going up. Were you doing rate caps at the time? Were lenders requiring rate caps at the time too?
So some lenders were not requiring rate caps. And just to clarify, rate cap is not cap rate for people listening, but it's a rate
Thanks.
cap.
Yeah.
It's interest rate protection, like an insurance
Hmm.
hedge. How high can your rate go up?
Yeah.
So yes, we did on some. In general, the lender didn't require it. We didn't necessarily do it.
Hmm.
And people are like, why didn't you do it? Well, okay. Do you think lenders didn't require it? So what do they think was going to happen to rates?
Not, yeah. Yeah. Most people were saying the federal funds rate might go from 0 to 2,
That's right.
you
And
know?
if you look at it and say, even if you had a rate cap and
Hmm.
you fast forward, so
Yeah.
2021 and 2023, basically an 18-month period, the rate caps went up like 3,400%.
Oh,
Meaning,
they're ridiculous.
you
Yeah.
know, if you had a $100 million loan, it was $98,000 to buy a rate cap in
Hmm.
2021. Fast forward like, a year and a half. Now, when you have to go renew, you're
Hmm.
like, okay, here you $3.4 million dollars. And to make matters worse, some lenders would say, well, we don't think your deal's worth as much anymore. So we're going to do like a loan rebalance on you. We want $5 million from you as well. So
Yeah.
the rate cap definitely can help you protect, provided it's enough protection because it only protects you so much. If you had the option to buy, like, let's say a 3 year rate cap, even though your loan is like a 2+1, so a 2 year
Yeah.
plus extension, you're probably better off buying it. You could look back and say, oh, I wish we wouldn't have done that. One, you
Yeah.
can sell the rate cap. We've sold some of them for like a lot of money.
Yeah.
And you're at least putting guard around how much is this going to cost. If you wait 2 years down the road and it goes up 3,400%, you're screwed,
Yeah.
you know?
Yeah. Now, more for people listening, if rates look like they're going up, rate caps are ridiculously expensive because the insurance companies are expecting rates to go up, and so they're going to charge you a lot more.
Right.
If rates are coming down, or expected to come down, rate caps are going to be pretty cheap. In the middle of rates going up, I was an LP on a property where they got a 1 year rate cap when they purchased the property. They paid over $1 million for the rate cap, but when that expired and they tried to put another rate cap on it, it was almost like we'd rather foreclose on the property than pay
Yeah.
this fee, right?
Can't do
So
it.
going back, I mean, I remember sitting at the Best Ever conference in like early 2022 before the rate cap cycle, and all these economists are sitting on stage and saying, "Yeah, we'll probably see the federal funds rate hit too." We're everybody's gonna be doing things. It's gonna go up to 2, and before prices start adjusting, it's gonna come back down. And that was what everybody was saying. And I hate to say it, I drunk the Kool-Aid on that one
Yeah,
too. So
100%.
yeah,
And there's
but
people who are like, well, how could you do this? Like, okay, you're using information. I mean, that's the lesson
yeah,
learned too. It's like you need to make your decisions based on the information you have today, whether you're
yeah,
looking at a new deal. I consult and coach people that have a lot of distressed
mhm,
deals, people that everybody on listening
yeah,
would know. And I'm like, you need to make your decision. It's a tough decision to get to the point where you're like, I failed, which you,
yeah,
you actually did. You failed in the project, right?
mhm,
But it's much different when you're like, all I'm doing is dumping money. And I talked to a guy, I guess maybe like 9 days ago, and he's dumping, 50 grand a month into one deal and money another deal. I'm like, dude, I did all that. I ended up putting in millions of dollars
mhm,
trying to save these deals, survive the 2025. You know what happened?
yeah,
Ended up the exact same spot. The only difference was that the investors lost more money and I lost more money.
yeah.
And it was a dumb decision to do it. So at some point in time, you need to make
Cut and
that
run.
really, really hard decision. It's like the
Mhm,
better of the bad decisions, and you either
yeah.
save it, sell it, or surrender.
Yeah. Now, pure dumb luck for me, we had a local credit union where we were buying properties that gave us bridge-like terms with a fixed rate. I've still got one loan fixed 3.7%.
Nice,
Yeah.
nice.
And to be quite frank, if it wasn't for that credit union, I probably would have lost a couple properties. We liked their product. We got in good with them, and I think at one point we had 4 loans with the same credit union.
Yeah.
But
I mean, are those
yeah,
full recourse loans? Just
they
curiosity.
are.
They
They
are.
are
That's
full
that's one of
recourse.
the differences. Don't get
Yes.
me wrong. I still, the non-recourse is a little bit misnomer. If
Yeah.
you're doing agency, you're a lot better off on the non-recourse, but a pure bridge lender. So that's it. That is a trade-off, right? You're
Yeah.
like, well, hey, you go to a bank or credit union, typically it's going to be full recourse, which means
Yeah.
you have personal liability
Hmm.
if something doesn't perform. On some of the other deals with non-recourse, even if you have carve outs, I mean, these lenders are going to have a hard time proving
Yeah.
that, these carve outs were triggered.
Yeah. Let's talk about lenders. Let's talk about loans. What typically happens, when a property starts sliding before the loan goes bad, and then what starts happening,
Yeah.
when you start missing payments.
Yeah. So first, I mean, understanding before you get a loan, understanding who your lender is, which I
Yeah.
really didn't care, whoever gave the best terms, right? So if your lender's an operator, meaning they run properties themselves and or they sell their loan off to investors and things like that, they're going to be a lot less likely to help you. Doesn't
Hmm.
mean that they're all that way. So I've been
Yeah.
on calls personally, the calls with lenders, and they're like, we're an operator, we'll just foreclose on the property and take it. We can
Yeah.
operate ourselves. And I've
Loan
been
to
calls
own
with
job.
lenders that are like, we're not operators. We don't want the property. Let's work
Hmm.
something out. So a completely different perspective on how they do it. If you want to go back to your lender and do like a loan modification and you say, well, hey, I need some help.
Hmm.
I haven't seen, I'm sure there are.
Hmm.
I haven't seen a loan modification yet that didn't require the borrower to bring some new money to the deal. Like, so if your solution is to like, we just want to go to the lender and ask for like a lower rate and this and that, you can do that if you want, but they're going to be like, have you gone back to your investors? Do you have money to bring in? We're willing to work with you, but we want some money from you guys. I mean, it's
Yeah.
just, they're trying to mitigate their risk as much as possible. Communication is key. It is
Hmm.
keeping them up to date. I mean, who wants to have a conversation with a lender that can't pay your mortgage?
It's
Nobody.
not fun
No,
for either party. Not
either
fun.
party.
Yeah.
But you don't want to be the guy that's like, ghosting them, not returning calls, things like that. You want to just have those tough conversations. If you can meet with them in person, that's probably even better. And try to work something out and say, here's where we're at. But you want to have intel too. Like, what's the property worth today if we try to
Hmm.
sell it? And you get broker opinion values, which really for a long period of time there, they were completely useless. I mean,
Garbage. Yeah.
they're
Absolutely. Yeah.
useless. But at least you have that data point, what's your cash position. And then if you're going to do a low mod, there's a lot of things you can look at, whether it's interest rate, pushing the timeline out, maybe doing partly current pay. Like maybe it's, people are doing 6 and 3, which is still bad in my mind, but
Hmm.
6% current and 3 on the back end for interest
Yeah.
rate.
Kicks the can down the
Just
road.
down the road.
Yeah.
And
Yeah.
so say you're in default. So now you're like,
Yeah.
man, we're in default. Typically, you're going to get a call from the lender for one, and be
Mhm.
threatening you. You better put the money in. We're going to come after you, depending on who the lender is, right? And you're like, well, we don't have it. We can't put it in. We're trying to raise money. And you say, well, you know what? We can go back to investors to try to get money if you guys, the lender, can do a loan modification. Most lenders, my experience has been, well, we're not going to do a loan modification until you bring the loan current. We're
Yeah.
like, well, we're not putting more money into the deal until we know what you're going to do a loan mod. Well, that's not the way it works. Bring it current, then we'll talk to you. I mean,
Yeah.
it's completely asinine. I mean, anyone who thinks this
Yeah.
makes sense is completely all they're trying to do
We,
is squeeze money out of you, right? And I get
yeah.
their position. I'm not suggesting that I wouldn't be upset if I was a lender either. So then they're going to say, let's say you kind of agree to stuff. You say, hey, I'm going to do something on a pre-negotiation agreement, right? So it's called a
Hmm.
P&A.
Yeah.
And the P&A is, typically a document the lender says, we, the lender, and you, the borrower, are going to sign this document, and
Hmm.
it says we can negotiate with each other. No
Yeah.
details on what it's going to negotiation will be. In that, as a borrower, typically you're going to, admit to everything you did wrong, everything
Yeah.
you're going to do wrong, and you're going to release us as a lender anything we did wrong in the past and anything we're going to do wrong in the future. Sign
Yeah.
this, please.
Yeah.
Okay.
No.
So yeah, you get to the point. First, you're just like freak. Oh yeah, whatever. Here. Then
Yeah.
you're like, no, I'm not doing that. And then if I'm going to be doing stuff and they're going to work other things in there on the loan mod, like trying to get you even more on the hook, more things on the hook. So you really have to come to the decision and say, well, okay, nobody wants like no one wants to get property foreclosed on. Nobody wants to go through like litigation and things like that. But at some point in time, if all you're doing is dumping money into a deal, dumping, and all you're like is like
Yeah.
your investors dumping money in the deal, and there's really no end in sight. What are you doing, right?
Yeah.
And then you're like signing up to like take on more liability than you had before. It's tough, but you're gonna be like, hey, we
Yeah.
just can't make it work. And then
Yeah.
you're in a really tough, decision. And you get deed in lieu versus foreclosure and things like that. And depending whether it's foreclosure like in judicial, which means it has to go through the courts or not, the timeline. And then you're dealing with stuff like they
Yeah.
call it deficiency judgment, where maybe the lender typically buys it themselves. And
Hmm.
it says, "Oh, Brian, we bought this for like whatever. Now we were going to come after you for the difference."
Yeah.
So, you're usually going to be served, right? So
Yeah.
you're going to have someone knock on your door with a, 300-page document
Hmm.
serving you. And, if people say, well, it should just hide. No, don't hide, just take it. I mean, at some point in time, they can go through so many things and like, hey, we tried everything. And
Yeah.
just a side thing is really important. Your registered agent is who the LLC, the
Hmm.
address basically where legal documents and tax documents, things like that will go.
Yeah.
So Brian and I are partners. I'm the registered agent and I move. And I'm just like, I'm off. Like Brian's running the deal and we're getting liens sent to my property. We're getting lender lawsuit, blah, blah, blah. Brian knows nothing about it.
Yeah.
Right. And so you want to use a registered agent that is not your home address, not your partner's home address. It's a third party. You want to
Yeah.
make sure that both people are on there, that you're getting email notifications for this stuff. Because I can tell you personally, there have been liens on properties
Hmm.
that had no clue existed
Yeah.
because of that.
That's a good tip. That's a really good tip. And I mean, I know some people choose not to do registered agents because it's an extra expense every year, but
It's
it's
completely, it is
pennies
very
on the
silly
dollar. Yeah.
to do that. Spend a little, I mean, yeah, I
Yeah.
mean, who wants to spend extra money? Well, you're not, believe
Yeah.
me, if it's just you, no other partners, you want to do it and you're having like an address that never changes, but and depending on property, you have one property,
Yeah.
okay, you probably can contend with it, right?
Yeah. Yeah. Okay. We're low on time and we probably need to start wrapping things up right now. I think we could probably talk for like 2 hours, but I'm not gonna do that to you. Let's kind of look, forward looking. Okay. Right now we're sitting, it's April 2026. What do you think the next couple years are gonna look like for multifamily?
Yeah, I mean, it's been rough for the last few years. I think that, and frankly, you would talk to me like a year and a half ago, I probably wouldn't talk to you probably. Be like just curl up in a little ball, in
Yeah.
fetal position. I am excited again,
Hmm.
really for the first time in, probably last, 6 months here.
Yeah.
And I think some reasons why some of the uncertainty is gone. I mean, it
Mhm.
just is. It doesn't mean that the risk is gone, but some of the uncertainty, even with interest
Mhm.
rates, I know they're fluctuating here or there, but you
Yeah.
know, not 11 rate hikes in a row.
Yeah.
That part's gone. Some of the insurance stuff has cooled down, but I say be careful of that because next hurricane can change
Mhm.
that depending where you're
Yeah.
buying. I believe that a lot of people got out of the market completely, which is
Yeah.
good, and a lot of the markets are down. I mean,
Mhm.
10 to 40% depending where you're at across the
Yeah.
country. So the deals right now, in my mind, are going to be either discounted by the lender because
Mhm.
lenders, 2 years ago, most lenders weren't really negotiating. They certainly weren't discounting deals. They weren't
Yeah.
taking like a haircut on deals. Now they are. So
Yeah.
those are pretty good deals, and that's gonna make people a lot of money potentially on those deals. And then some of these deals, I think, where people are doing like a cash in refi,
Mhm.
maybe they're short a little bit. They were on bridge,
Yeah.
stabilized, and now they're going, to like a fixed rate
Yeah.
environment from like 11 down to 6 and need $1 million. Okay, you come
Yeah.
in as a new investor, sit in front of everybody, high returns, things like that.
Yeah.
I still think this year is gonna be pretty darn rough. I do. And I think buying like let's say you have a property you're listing, going to
Mhm.
buy a deal that's listed, I just don't see it happening right now. I mean,
Yeah.
I'm not saying like anyone buying a deal isn't getting a good deal. I'm not saying that, but as a
Yeah.
general statement, I mean, we're pretty in tune with the markets,
Mhm.
what's happening in the market. And
Yeah.
there are deals we sold where I'm like, I don't know why anybody would buy this deal. Like
Yeah.
I never would have rebought that deal.
Yeah. First of all, yeah, sellers who don't have to sell this year, there's no reason to sell. It's like you're supposed to buy the dip, not sell the dip. But so yeah, what we're seeing on the market is people who are only selling if they have to sell. And unfortunately, I'm in a couple spots, where we're selling properties because there's no other option. It's millions of dollars in or sell and take the haircut right now.
That's
But
right.
people who are buying in the last couple of years, me included, if we made a mistake, it was, hey, it looks like we bottomed out, and we hadn't quite bottomed out yet. But
Right.
yeah, hindsight, man, gets you every
Yeah,
time.
yeah, oh yeah, yeah, yeah. And I
Gosh, yeah.
think that I mean, it's hard to say because of inflation, the war, and things like that. But at the end of the day, supply is way down from where it was, and a lot of these markets got way oversupplied. So
Hmm.
there are a number of things going for
Yeah.
multifamily, but I do think this particular year I think is going to be pretty darn tough.
Yeah. Yeah. Awesome. Well, closing up here, what's next for you?
So we're coaching again, which I'm super excited. Again, if you would ask me
Yeah.
a year and a half ago, I said I'm done, I'm not doing it, and then I'm like, you know what, I've learned. I mean,
Hmm.
what I've learned is just really expensive, hard, tough lessons, and I'm willing to
Yeah.
share them. And I can tell you, they're not like lessons that cost like $10,000, $20,000 of savings. I like they cost like millions and millions of dollars and can save millions and millions of dollars.
Hmm.
So kicking that back up with the group and in the one-on-one coaching, we have an
Yeah.
event we're going to do. It's not scheduled yet, but it's going to be sometime in the summer.
Okay.
It's going to be real around like, yeah, what kind of went wrong, but more importantly, what can you do to get new deals going forward and find them on a discount and things like that, how to structure deals differently than we had
Hmm.
before. And then, I am looking at deals, but it's really more mostly on the cash refi. And then I get contacted a few times a week for sure
Hmm.
from other syndicators. One guy just sent me a deal today. It's a Freddie loan,
Hmm.
fixed rate, but just kind of needs to get out of it because,
Yeah.
occupancy has dropped, things like that. So those type of deals, pretty selective, but I'm not really actively looking at like, listed deals that much. It's all kind of behind the scene type deals
Yeah.
and probably would do deals with less partners than we had before,
Hmm.
frankly, and structured deals differently. But I mean, I still like multifamily for
Yeah.
sure. Just a lot smarter about how I'm going to structure things in the future, make less mistakes, and
Yeah.
and hopefully make
Yeah.
a lot more money.
Yeah, yeah. I mean, rebuilding, after a crash. So, yeah, a lot of people are in similar situation right now. And all right, next question. If you had to give advice to somebody who's just starting, even though the last 40 minutes or so is, pretty much that, but if you had to distill everything down to, 30 seconds or less, what would that advice be?
Make sure you understand the debt and you need to eliminate as much risk as you possibly can. Like if you get, for example, 35-year loan, you're going to eliminate your risk, what your rate's going to be for that period of time. You get a floating rate, you have no idea what's going to happen. So, limit your risk if you can eliminate it, mitigate it if you can, but focus more on your debt, location, make sure you understand taxes for you personally, because that's a big thing we didn't get
Yeah,
into. The location is huge, as far as
yeah.
evictions, and then, the type of deal, making sure you're using information based on today to make
Hmm.
your decision, not based on what the future is going to look like.
Okay. Awesome. And last question, how can listeners learn more about you?
You can reach out to our website, thinkmultifamily.com. We have a form
Okay.
out there as well. Or we're on social as well. And then
Okay.
email, you could do info@thinkmultifamily.com.
Awesome. Awesome. And I was going to say something about your guide, but I just typed in Think Multifamily and the free guide pops up. So for everybody there, he does have a free guide on his website. He posted something about it on LinkedIn. I got it. It's a really, really good guide. So head on over to his website, at least pick up that free guide. It will cost you an email address, but it's definitely worth it. So, well, Mark, thank you very much for talking as openly as you have. I don't remember if I had hit the record button when I said this earlier, but a lot of people aren't talking about it, and so very much appreciate you actually talking about the reality here, and hopefully we talk a year or two from now, and you're back on top of the world. But
Yeah, for sure.
yeah,
Yeah.
very much appreciate you.
Thank you, Brian.